The main discussion regarding impact investing usually refers to investment in initiative and usually refers to investment in initiative projects and private companies like Angel Sense that Impact First invested in, a GPS technology that helps protect children with special needs, and startups like those that were created to solve a social or environmental problem. When investing in these projects, the impact that you as an investor does is straightforward. You have a direct impact. You have a direct impact. The impact is tangible, and you can actually see how you are changing the lives for better. But those types of investments are long-term, not liquid, and are often quite risky. This is the reason why when we look at the spread of a wealthy individual portfolio, those type of investments will consist only of about 10% of the portfolio, mainly as part of the asset allocated to alternative investments. And most of the money, 75% of the wealth, will be invested in public equity and bonds. This is true even for impact investors. In today's panel, the three of us will discuss how to create measurable and meaningful impact in investing in the public equity world, the assets where most of our money is. I will open by presenting the definition of impact and how to create impact by integrating SDG, ESG, and other factors. Catherine Bellamy, the product manager for sustainable goods and services in VE, which is Vigeo Eiris' new name, will explain VE's methodology for identifying the companies that are creating real impact through sustainable goods and services. And Elal Kalai, the VP for Business Development at IBI Investment House, will demonstrate how do they implement impact investing in IBI and how much interest do they see from investors. So first of all, in order to be less formal, I will ask Ella to present me.
Okay, now I'm unmuted. This is a great honor, Noga, and I would like to say that Noga is actually a serial entrepreneur, if you haven't known that. Her latest venture is Value Squared Responsible Investment Fund. Before that, she founded and is the CEO of Greeneye. In 2016, Greeneye was awarded the Green Globe Award for groundbreaking advances in the field of responsible investments in Israel. And that's pretty much an understatement. Noga has more than 18 years of rich experience leading change in Israel's ESG. I was there alongside her and she never let up, pushing us forward and bringing Israel to the place it is today to such a conference. She was working with the government, with NGOs, and obviously with the financial and business sector. Noga is also a TEDx speaker, and she holds a master's degree from the London School of Economics and a BCS from the Technion. She lectures, writes, publishes, and is someone to follow.
Thank you very much, Ella. So let's start. In order to assess the impact in public equity world, we first need to go back to the definition of impact investing. One ahead, Ila. Another one, another, yes, wonderful. The common definition of impact investing is investment made into companies, organizations, and funds with the intention to generate measurable, beneficial, social, or environmental impact alongside a financial return. The first tool to generate, can you move one? Sorry, thanks. The first tool to generate measurable beneficial social or environmental impact in public equities is investing in those companies that derives some of their income from sustainable goods and services, and advance the world toward achieving the UN Sustainable Development Goals for 2030. In order to reach those 17 goals by 2030, the financial estimation is that we need to move from the $1.4 trillion that are invested currently in the goals to $3.9 trillion in the coming years. The only way to close this gap of $2.5 trillion is that the world of public investments will be directed that way, to encourage more and more companies to direct more efforts to develop solutions to those goals. In order to choose those companies that are already on the way, we are looking for two parameters: the types and the amount of sustainable goods and services, how many of them they have, and the amount of revenue that are derived from their sales. But by the way, what would you attach more importance to? The amount of products and services that the company has in the field, or to the amount of revenue it receives from each product? In other words, which is better? A company with 10 products and services in the SGS areas, but whose total income is only 10% of the company's income, or 3 products and services that promote the field that constitutes about 70% of the company's income? These issues are discussed in the policy level of the investment fund. But how can sustainable goods and services affect their portfolio impact performance? The short answer is almost twice the impact. Here, for example, is the value squared portfolio, which has 584 billions of revenues stemming from SGS. This is almost 29% of the total revenues of the companies in the portfolio. If we compare it to other funds, the number are many times smaller, mainly because SGS is not even in consideration in many funds' investment decisions. But having income from SGS is only one out of 6 components that we need to manage in order to generate a measurable, beneficial, social or environmental impact. In order to find real impact, we need to dive deeper to the various impact components. If you see here, the main components with impact investment is the ESG component, the environmental, social, and governance area. The ESG component actually includes dozens and even hundreds of some indicators within the 3 areas of environmental, social, and governance. Question like, are employees treated well and fairly? Does the company provide decent living wages? Is the board of directors diversified? How many women serve in the board? What about minorities? Does the company pay decent tax? All of those questions are only a fraction of the indicators we look at. When assessing the ESG, we are not looking for those companies that are hedging the risk by minimizing their negative impact, but companies that are leading and are intending to create a positive impact by contributing to a better world. It's important to say that out of all the impact components, from our perspective, the ESG component is the most important one. ESG expresses the essence of the triple bottom line: people, planet, profit. A company that is performing well in the ESG component, just by the way it conducts, produces an impact. And this has implications both for the ability to create a better and more generous economy, and also for financial strength and resilience of the company itself. Other factors, like excluding companies that are involved in controversial activities that don't align with our values. Another factor of impact is not investing in companies that are involved in critical and problematic events. And in terms of fighting climate change, we are looking for companies that are decreasing their carbon footprint and investing in those companies that are more energy efficient. All of those 6 components create a measurable impact. We need to make an impact in our public equity portfolio. This is the impact assessment that we send every month to our investors. The impact results speaks by themselves. Less than a quarter of the carbon footprint, double the income from SDGs, 20% better impact score that integrates all of those together. But in order to assess all those 6 components, we need the highest quality data and experience you can get. Because as we know, even the best chef can't make the best dish without the finest ingredients. Value Squared has found VE to be just that. Now I'll hand it over to Catherine to present the work of VE that they're doing. But before that, I'll present Catherine. Catherine is a product manager for Sustainable Goods and Services, what we call SGS, research team. She joined Vigeo Eiris in 2016 as a specialist research for then newly launched SGS product and contributed to the development of the methodology. Catherine has a Bachelor of Applied Sciences from Simon Fraser University, Canada, and Masters in Project Management, Sustainable Development from the Conservatoire National des Arts et Métiers. Sorry for my French. Catherine, the floor is yours.
Great, thank you very much for the introduction, Noga. So just as Noga said, I'm part of the specialized research division at Vigeo Eiris. So Vigeo Eiris is an ESG data provider. I am passionate about sustainability, about identifying, about researching solutions to sustainability challenges, and also identifying solutions-oriented companies. So companies with business activities that address sustainability challenges. I feel very fortunate that I'm able to develop this passion in my work. So specifically managing a research line that is focused on sustainable products and services. In this presentation, I will discuss the importance of impact investing and also discuss positive impact data. So how this data is collected and how it can be used to support impact investment strategies. If we could switch this slide, thank you. So the United Nations launched the Sustainable Development Goals in 2015 with a very well-defined agenda to promote economic growth, social inclusiveness, and environmental sustainability. Noga has already really covered the different parts of the Sustainable Development Goals, but the main point I'd like to say here is that the SDGs are relying heavily on the private sector for success, so requiring between 2 to 7 trillion US dollars per year. And this is more than the public sector has. So it's quite dependent on the private sector. The different economic consequences have already been discussed, particularly in the Stern review. But really the main point is that I wanted to make here is that since the launch of the SDGs in 2015, there has been a real shift in mindset. So for a long time, the focus was on reputation, so on financial risk. Investors were really taking a protective approach with investments. But this mindset has really shifted. A growing number of investors are looking to move beyond traditional ESG integration, so towards different impact investments using different approaches. So ESG anchored investing is already on the rise. Most of the major institutional investors are already integrating ESG factors into investment strategies. There's still lots of activity surrounding impact investing and the SDGs. So on this slide here, I'll just describe what the objectives of Vigeo Eiris's research is. So the objectives are to identify business activities that are providing solutions to sustainability challenges, so through products and services that are being offered, to assess social and environmental benefits from products and services, and to support impactful investment strategies. So our research, really the companies that are included are all listed public equities. So the information that we base our research on is all from public documentation. Ultimately, what we are providing with the research is a positive screening, which is complementary to the traditional ESG approach. So generally, we would it's a positive screening versus a negative screening. That's sort of more traditionally used in the industry. The research is organized under based on themes. So we have 9 different themes that address core sustainability challenges. I will describe the themes on the next slide. Ultimately, what we're providing is a data set that is customizable. So we can choose whether we are more interested in make investments in environmentally sustainable products or products with a social impact. So we can choose between those two. Overall, the idea is that our SGS research should be used in conjunction with other research lines. So to really have a holistic approach, we can remove disputable activities, avoid controversies, look at the ESG score. But the idea is really to, in the end, to use the research to focus on companies that are answering social and environmental challenges. So companies contribute to the SDGs by mitigating harm, acting responsibly, and finding opportunities, which is where SGS research comes in. So in terms of our assessment, we are doing what we call a screening for sustainable products and services. Oh, sorry, if you could just go back. Thank you. And we have identified over 90 sustainable products and services within the scope of 4,700 issuers and more. We've identified 9 different themes for investment and 2 classifications of impact. So either environmental impact or social impact. So the products and services were selected based on sustainability objectives defined by international organizations, so the United Nations and the OECD, and then classified under 9 different themes. So the SDGs are huge. They cover, there's many different targets. Some of them are applicable to private sector, some are applicable to public sector. So what we've done is kind of simplified it and organized it under 9 different themes, which are transversal, so they can be related to different SDG goals. Themes cover basic needs, so water, energy, food, development tools, education, social infrastructure, as well as environmental solutions, such as renewable energy, pollution abatement technology. And overall, it can be used to show the impact of a portfolio. So communicate to stakeholders what SDGs are the companies within the portfolio are contributing to, and use the different themes as a reference. So for the next slide, please. In terms of the assessment process, the first step we do is identify relevant activities. So look at a company's product and service offering to see if any of the products and services are relevant for our research, so addressing sustainable development challenges. Next, we want to quantify the involvement of that company. So our quantification, at this stage, this is where we determine how much revenue the company derives from that specific product and service that we've identified. The next step is to categorize. So this is what I would call more of a qualitative analysis. So looking at the core sustainability challenges that are addressed by the companies. So this is where we would match it with one of the themes. and finally classifying it. So what is the level of involvement? No involvement would mean we didn't find any relevant products or services. Minor involvement we define as revenue that's less than 20% of total revenue. Significant is anywhere between 20 to 50%, and major involvement is over 50%. And we classify at all levels. So what's interesting here is that the level of involvement is of interest, because a low level does not necessarily mean poor performance. You could have companies that are new to the market or just starting to incorporate a strategy to integrate SGS. So we put the same amount of effort into finding revenue thresholds for all companies, regardless of sector or their business activities. So next slide, please. In terms of performance, key findings. So this is within what we call our universe of 4,700 plus issuers. The results are interesting in that if we see we have 36% in the none category, so no products or services. So that's only 36%, which means the majority of companies that we've researched actually do offer, with varying levels of involvement, sustainable products and services. 48% companies are in minor category, so less than 20% of revenue. So the majority of companies fall within this category. And then we have 11% major, 5% significant. So we have 16% of the companies that we have collected data on. So these are issuers that could be considered suitable for high impact investment strategies. These are companies with a larger share of revenue related to products and sustainable products and services. So then next slide. This is just to show, again, overall findings. On the left, we have zone. So this is geographical zone. You can see there's no major geographical bias. So we have Asia Pacific, Europe, Middle East, Africa, North America, and the rest of the world. The results are quite similar. So there's no better performance according to where the company is performing the business activity. In terms of sectors, some sectors, I guess you could say, logically outperform. We're going to find more sustainable products and services in the sectors that have the full, more of the dark green, so major involvement. Healthcare equipment and services is no surprise. Pharma and biotech, waste and water utilities. And then other sectors correspond to involvement in social infrastructure, renewable energy, etc. But we don't base our research initially on the sector that the company is involved in. We do find products and services across all sectors. Next slide, please. I just like to go through a quick case study to show, hopefully put this in perspective to show how it works. I've randomly picked an example here, which I think is interesting because of the diversified offering. So we have a group called Kingspan Group. It's a building materials company based in Ireland. And we can see here, the main business activity of the group is being in building materials. It makes insulation materials. So this company in particular makes very high efficiency thermal insulation. This is important because buildings are one of the most responsible for carbon emissions. The insulation materials contribute to energy efficient buildings and participate in the reduction of carbon footprint. It also, Kingspan also offers renewable energy technology. So it develops integrated solar rooftop systems for commercial applications. It offers equipment for rainwater harvesting, wastewater management, pollution abatement technology. And yeah, overall, we're able to assess revenue from the different products, and we can add it up at the company level. And ultimately, we have at the end is the different themes. So if we're interested in companies that are contributing to energy and climate change, this company, for example, has a major involvement. In the other themes, it's minor involvement. Just to quickly conclude, I'd like to conclude my remarks by addressing one last important point from a conceptual perspective. The positive impact derived from products and services exists on a spectrum. So some products and services are more sustainable than others, but that doesn't make them perfect. So the time horizons in which society as a whole can benefit from products and services vary significantly. If you take vaccines, for example, the benefits would emerge quickly, and over the long term, look at the benefits of educational initiatives. These emerge mostly over the mid to long term. So these dynamics are important for investors to keep in mind as they develop positive impact strategies or funds. So our role at Vigeo Eiris and within this whole ecosystem is to help investors identify opportunities for positive impact investing.
Wonderful. Thank you, Catherine. And we are running to hear Ella. Ella is a unique manager in the stock market in Israel. She is the first that understood the need of integrating impact factors in the investment decision process, and she is leading the way. Ella currently is the VP for Business Development at IBI Investment House and chairperson of the IBI Mutual Fund. Ella has worked in the capital market for over 25 years. Ella co-founded IBI's Women Investment Forum, IBI's ESG and Impact Portfolio, among other initiatives at IBI. Ella holds both an MBA and an MS degree in biology from the Faculty of Physiology and Pharmacological, both from the Tel Aviv University. Ella serves as the chair of the Israel Women Network, is a member of a number of NGOs board. Ella published financial columns and an editor of the Israel Economic Media. Ella, the floor is yours.
Thank you. So I would like to start by saying that we're living in a very lucky time, because it is much easier these days to create value from impact than any time in the past. And if you could please go to the next slide. As I work for an investment house, I have to add this disclaimer that we might have conflicts of interest in our investments, and that please regard the examples that I will give as examples and not as recommendations. The next slide talks about what has been talked about, and the only thing I would like to add to what the previous speakers said was that really what we should have here is a picture of a cup half full, because the SDGs represent the needs of the world, but also the huge opportunity of investors. So I have, through the presentation, a few examples of how the Israeli financial markets, Israeli equity, can address these SDGs. So water is an easy example. Most of you know that since the invention of drip irrigation, I think Israel was considered as a water nation way before it was a high-tech nation or anything else. And in the water section, if you go down to the next slide, then I would like to just point out two companies, one traded on the Tel Aviv Stock Exchange that does those meters you can see on the right side of the screen. Basically, they allow municipalities like Tel Aviv or Sao Paulo to manage their water system in a very, very efficient way. So this is currently, it's probably a small, medium company globally, but it's a very nice, large company and growing Israeli company. The other example here, there are more than just one. Go back to the previous slide. Water treatment. There are several Israeli companies traded on the stock exchange that do water treatment. Some of them, sorry, not traded on the Tel Aviv Stock Exchange, but globally, Australia and other places. And these opportunities are also huge because part of what's happening in the world of water, like in the world of electricity, is that we're going local rather than having nationwide networks. You can have a water treatment facility for your community or for your building or for your farm. And it's become way more economic than previous solutions. So these are just huge financial opportunities, and it's not difficult to see the value and the impact that they have. So now you can go to the next slide, which is another example of an Israeli company. This is a little bit more complicated. Wix, which possibly you know as a company that will allow you very efficiently to build your website. And the reason that I think that it does both 8 and 10, reduces inequality and allows for better economic growth is, you will have to go to the next slide. Hila, the next slide, please. This is their vision. Okay, so that any person or community can create their dreams online, both their personal dreams, but also their financial dreams. And if you go to the next slide, basically it talks about how Wix allows you to do this through their apps and their basic platform and the marketplaces that they give a very, I would say, not even small business, but what's smaller than small, really very basic businesses, the ability to do their CRM systems, their ERP, their customer management, their scheduling, their marketing tools, their electronic payments, and so on. So not just build their website, which is maybe an obvious, but the tools to be successful, to compete on a global arena. And so the good news is that they allow companies to do this. The more difficult news is, even though they have all this information, they're not reporting it to VE. And so global investors probably have a very hard time of defining this and of measuring this and of seeing how this advances as the company advances, even though this is the focus of their business. And if you go to the next slide, I would like to talk just a little bit about gender equality, because that leads us to the possibly to the complexity of what we're talking about. And so you will have to go to the next slide, because when we talk about gender equality, I think we will all agree that it's way easier said than done. I think most people will say that they are totally in favor of gender equality, but then most people find it more comfortable to be with, when they're outside of their family group, they would find it more comfortable to be with their either if you're a woman with your woman friends, and if you're a man with your man friends. And of course, there are situations where we're very happy to be everyone together, but in many social events, we will find the women in one side of the room and the men on the other side of the room. If you please go to the next slide, this is the outcome of the fact that we're more comfortable that way, because men are more comfortable with men, and they will choose the boards, and they will choose the management, and they will choose their next employee with people that they feel more comfortable with, not with people that they need for diversity or for
Innovation.
Everyone else speaks Hebrew, so I think we're fine with that. So the next slide, please. And so part of the fact or part of the difficulty that we have with gender equality And probably with ESG and SDG is that counting is incredibly important, but it's far from enough. Because if we just count how many women are in different places, so this is our parliament, the 125 largest companies on the Tel Aviv Stock Exchange. It should have 2 actually CEOs. I'm sorry about that. Presidents, teachers is in pink. So please go to the next slide. Counting is important, obviously, if you want to do your ESG and SDG properly. But if I bring this example of an ETF by, what's the name of this company that put up the statue of the fearless girl? They put out this ETF that measures women's leadership in companies. So basically what they do is they invest in companies that have more women on their boards, more women as CEOs or C-level executives, and they invest in those companies. And this ETF did not outperform the S&P or the comparable index. And part of the difficulty of this is that if you just count how many women are there, it's not good enough. So it's not just about counting, it's really improving what it is that we're counting, how we're counting it. And if you go to the next slide, I would like to conclude by saying that this is actually, you know, ESG and possibly even SDG have been around now for quite a few years. And they're still young. We're still learning how to do this properly and how to make more and more better investments, how to improve our investments and how to make more money so that we could invest more in improving our world. But it's still very complicated and it's still very young. So I would like to say that, you know, we have companies like some of those that I've just shown you, that it's very easy to explain their SDGs, but they don't necessarily measure them, or they don't necessarily measure their ESGs, and possibly will not have very high scores on the ESG if they did measure them. Reporting is incredibly important because if they don't report, we will not know what's happening there. But investing is probably more important, investing in producing the impact. So if we have a company like Wix that invests in having more positive impact, at the end of the day, at the end of my day, it's more important than the fact whether or not they're reporting on it. So this is still a complicated environment to follow. We're getting better at it, thanks to companies like Vigeo, Eiris, and Greeneye that give us the information that we need. And hopefully next year we will be even better. So hope you come and invest with us in the most exciting investments that are out there. Thank you.
Thank you so much, Ella. And just before we go to the central stage again, or the central hall, we want you to take away one poll. We hope that we managed to influence you a bit of your perspective about impact investing. So let's see if that works. If you had the option, would you want your portfolio to be invested according to impact criteria? Okay, so we see that some of you did agree with that, with the idea. Some things that are, we still want to do it in the alternatives, but we do hope that you took something from this conversation, and I think it was fascinating. So thank you, everyone. Thank you, Ella. Thank you, Catherine, and thank you, Hila, for organizing it. So thank you.